Hi, everyone. Thank you for joining WisdomTree's Office Hours Fed Watch, still playing the waiting game, where you'll hear from Professor Jeremy Siegel, WisdomTree Senior Economist, Jeremy Schwartz, our Global Chief Investment Officer, and Kevin Flanagan, our Head of Fixed Income Strategy.
Professor, we've got a little bit of a holiday shortened week and a few things happening around the world. The Fed not being one of the most interesting stories, but there is some drama around the table. I'd love to get your latest assessment, your thoughts of what Powell's doing right, what he's doing wrong, and your current views on all that's happening here.
Yeah, absolutely. Well, let's go to the Fed. I mean, obviously, there was a slight hawkish tint, I thought, to the Fed commentary. I'll tell you why in just a minute. Certainly, there was a hawkish tilt on the dot plot as we actually doubled the number of people thought no change in interest rates this year. I think there's a number of questions. And again, if I were in the room, I would have asked Powell the following question, maybe put it this way: if we suddenly had a national sales tax of 10%, and we know prices would go up, not by 10, but 6 or 7, because suppliers would absorb some of it. Would that be a time to tighten monetary policy? Well, most economists say absolutely not. Well, tariffs are a tax. They're a tax on imports. So why would you want to tighten when there's an increase in the tax? Instead, first of all, no one asked that question, which I would have asked. But his answer gave somewhat of a hint that, maybe yes. He made this statement, and I think this is a little bit when the market started going down. He said, we do believe that tariffs are going to start raising prices, and we have to take that into account. Well, obviously in your forecast you do, but does that mean that you're going to, delay your cuts or even raise? Does that mean you believe that you should tighten in face of a tax? It doesn't make sense to me. I've been saying for months that you got to look through the tariff bump. Now, he did again talk about going into expectations. Well, obviously there's a range of where tariffs are going to go. I said, I've been saying for weeks and weeks and weeks, the market has settled down to where it is now, and they think it's going to be nothing worse. That may be wrong. If Trump gets the tariff religion again, but at this particular juncture, 10 and 30, as we've talked about, everyone in China, there is a deadline on July. It's going to be put. I think anyone who puts anything on the table, even if it's almost scribbling on a napkin, is going to get another delay. Maybe there'll be a few countries that will displease him, and he might do some hikes, but it won't be major. So this is what basically people would deal with. I've always said that I thought that the market could handle that. Basically he said that we're waiting to see what will happen. Now, another interesting thing I did, it was interesting, and maybe it was pressure from what's happening in Doge, but, that the Fed is going to decrease over the next 2 years its headcount by 10%. And he actually said, we didn't think that was going to affect the services. Like, we can get rid of 10%. Well, now think about that. I've been making the case that AI, if employed properly and more intensively by firms, can do a lot to offset the tariffs. I'm not saying completely, and certainly 25 and 50% tariffs, let's say, on autos, aluminum, steel, etc. That is not going to be made that much more efficient. But a lot of firms have room to reduce their head count and will. And now they're going to be pushed to, and now they have an excuse. I mean, gee, I'm sorry, we like you, but hey, with these tariffs, we got to watch our margin, and there's going to be layoffs into the future, and I think that the Fed will react to those layoffs. In terms of what we're seeing so far, again, we did get a Wednesday, 1 day early because of the Juneteenth holiday on jobless claims, and they stayed just above my 240 upper range for good levels, but they did not increase. Actually, there was sort of a sigh of relief because there was some fear that they may be jumping up. So jobless claims are on the high side. Continuing claims continue to inch up. I'm not exactly sure why, given that jobless claims are pretty well behaved. It has to do with, once people are getting those jobless claims, they can continue to get them. A lot of them has to do with the policies of the state and the policies of how many months you get on before you get reviewed again, et cetera, and so on. And the continuing claims, as you know, are a week behind. But the jobless claims stayed at 245. They did not rise, any further. We did get weak housing starts, but this quarter, which ends in 2 weeks, looks like it's a 3.5 quarter, and we've talked about that, averaged that in with a minus 0.2 on the first quarter, and you get a 1.7. Now the Fed, I'm just looking at what they think that real GDP is going to be 1.4, so they think the second half is going to be a 1 or even slightly less. And they think it's going to be definitely tariff-induced, and obviously they think inflation, because their forecast for the PCE is 3.0. Well, that means the second half has got to be, well over 3, because we're well under 3 at the present time. I think that they might be surprised that inflation isn't as bad as expected, and that layoffs may be worse. I understand that the layoffs from the government they're on a payout right now, and I think it's the month of September that it really will. Those government layoffs actually do get into those unemployment statistics and the jobless claim statistics. So there's a lot of delay in terms of what should happen there. Powell definitely acknowledged there's been a big bounce back in sentiment, which we all know from the surveys. I mean, no one is as gloomy as they were on, April 2nd, with the pause in the tariffs, and that Trump has been rattling the cage. He hasn't called for Canada to be the 51st state, nor has he called for the annexation of Greenland in the last couple of months. We certainly should comment on the Iran Israel war. This has a potential. There's obviously, again, a distribution of results of which some can be bad, but this has a potential of being quite a good outcome. It's clear to me that Trump supports the Israeli strikes. There's a lot of quiet support for the Israeli strikes, and it appears that Iran has been pretty well neutered in its ability to respond. There was word we're going to get that there may have been a tentative reach out to President Trump and the White House on some sort of negotiation. Trump says it's not too late. Will the U.S. Let me put it this way: if they do not reach out in the next couple of days, and Netanyahu does ask Trump to bring in the B-2 bombers for the bunker bombs, I think there's a good likelihood that would be done. Is Iran capable of shutting the Straits of Hormuz, where 30% of the oil passes through? They did it once before, and they met tremendous U.S. Retaliatory pressure. Certainly that would spike oil, but it would also basically lead to the destruction of virtually all of Iran's infrastructure. Again, they may be pumping 3 million barrels a day. If in this worst case scenario, if Saudi Arabia and a couple other countries could pump up to do that, but that would of course still mean with a spike in prices in that case. Again, the U.S. is mammothly more insulated from a spike of oil than it was 40 years ago, 45 years ago. I'm not saying it would have no effect, but none of the effect that we had then. There was very little discussion. There was maybe one or two questions from the press corps to Powell on that. Did not give any sort of answer that said that they saw that as a risk, or didn't even answer, well, if there is an oil spike, what will you do? Will you tighten because inflation goes up, or will you loosen? There was no statement as far as that is concerned. Nothing really surprised me off of the Fed meeting. As I said, I wish there was a direct question. If it is a one-time increase, would you, and it doesn't go in expectations, what would you would that be something that you would tighten against? Obviously, there's some FOMC members that think yes, because a number, as I said, I think had almost doubled of FOMC members that thinks there should be no cuts between now and the end of the year. Let me make the case that I've made for 2 or 3 months. My feeling is that the Fed funds rate should be about 100 basis points lower than it is now in the 3.5 range. Now there is one other thing I want. Again, when I talk about people not asking questions, a week and a half ago, Senator Ted Cruz from Texas really went on about the Fed, spending $200 billion a year on interest on reserves. And maybe since Congress controls that, he said maybe we should cut that down. I thought there should be a question on that to Jay Powell. I mean, when he talked about the quinquennial review that they have about monetary policy. Oh, should we, reform the SEP and all that? I mean, that's popcorn compared to these big questions about what the Congress could do to the Fed on interest on reserves and monetary policy and some of the issues that I've talked about. That's what really they should be talking about. Not, maybe we'll have 4 years rather than 3 years or 2 years on our SEP, and should we have a dot plot or not? By the way, he did emphasize, the confidence that FOMC members have for their dot plot in 2026 and asked 2027. Who knows what's going to happen in 2027? So, I mean, he said there's not much, as his words go, conviction in those. I've often said, I mean, they're sort of written on tissue paper. I mean, they're sort of, well, this is what I said last time. I'm bumping it one way or the other. Deposit growth continues at a slow pace, not devastatingly slow, but year over year, I look at deposit growth and it's 4%. M2 money supply is a little higher, and that's currency. No young people seem to use currency, but people are hoarding currency. There is, there's a lot of it used. I mean, part of it, that's also used. I do think, some of these developments on stablecoin are interesting. J.P. Morgan is talking about maybe building a transaction mechanism on stablecoin. These are big, interesting issues that are coming up. Just to mention, as far as the deficit, they're still wrangling. It's been my position from day one that this thing is going to be done. They will get the votes. They will get the votes to get it done. Not everyone's going to be happy, but you're going to get it done. The bond market basically believes that, and at this particular point, they see that at least the 10-year bond is well behaved. 30-year bond, the spread. I'm looking at the spread between 30 and 10s to see whether that far out is actually increasing or not. I'll have more information on that next week for you when I finish my research.
Professor, I wanted to ask you, I mean, you mentioned next year, 2026, they actually downshifted a little bit in the dot plot, but also next year, we're going to have a new Fed chairman. Not beforehand, right? Not beforehand. He's not going to get fired, but we will have a new Fed chair. And it's interesting, if I'm not mistaken, I think it's May 2026. So there are 3 Fed meetings before May of next year. So, I mean, do you think basically Trump's going to hold the litmus test is basically going to be, I want someone who's going to cut rates more aggressively?
Well, Kevin, look at May is 11 months away. At the rate events are going, what's the world going to be like 11 months from now? Yes, he wants rate cuts now, and as I say, I believe there really should be some rate cuts now. But who knows what in 11 months what it is going to be? I do think it would be. Trump made a comment a couple weeks ago that he was going to name that would be totally unprecedented to name a Fed chairman 11 months before the old Fed chairman, the current Fed chairman's term is up. And by the way, there was a question from the audience to Powell, would you remain as a governor, which he has the right to do? And he didn't answer that. But the answer I will give you is no, he will not. You do not remain as a governor when the president doesn't reappoint you as chairman. Anyone want to bet with me on that? I'll take that. So, that, if you know anything about the dynamics of what goes on. So, Powell is a very, very good man. He's a smart man. He's absorbed a lot about monetary policy. He's made some bad mistakes because he hasn't had some background. It's not, ultimately the buck stops here. And he doesn't have a lot of the background. He doesn't look at the money supply at all, and he doesn't look at the growth of credit at all. He doesn't know the failings of the ample reserve regime and what the problems are. But outside of that, I think it was a good news conference on answers. Again, I would have asked a lot of questions here that were not at all asked. But given he seemed very well prepared and more confident, I thought, than really the one that he had in May. Despite the fact that in the morning, Trump really came down on him, to say the least.
Well, that's an interest. Let me just follow up on that, because we just got a question in where I know what your answer is going to be, but for our audience, does but basically Trump saying this to Powell, is it basically influencing Powell, but the other way around? Instead of cutting rates, I'm not going to cut rates because I don't want to be viewed as being political or
Yeah.
influenced by politics.
That often works on a subconscious level. You use, he may say, no, I'm going to let the data, but the data is always looked through a prism of what many emotions, and some of that emotions might be, I'm not going to just do what you want. I don't want to appear to cave in to what you want. That being said, if the unemployment rate starts rising, and if some of he said the economy is rolling along. If it stops rolling along, he has the rationale to do that. And I think if it starts slipping, the political pressures on all sides will be strong. And despite the tariffs and what kind of bump the tariffs might actually do, he will lower rates. That may be too late to prevent a deeper downturn, because if you have to wait until you react to real data, you're instead of forecasting that data. I mean, I thought one of the things he said monetary policy has to be forward looking. Then he says we're data dependent, like we're going to do what the data says, which is backward looking. I mean, well, which way is he going? We're going to wait until unemployment data goes up. You know how lagged that is. And then he said, we know the bump in prices is going to come. So as a result, we've got to take that into account. So that's forward looking. But do you know how much inflation is going to take into account? Do you know how much slowing is going to take into account? Are you making a forecast there and not making a forecast in other places? I don't know. There's a lot of there was, in my opinion, a lot of contradictory rhetoric here. But I think the bottom line to answer one of our listeners' questions is that if the data starts getting weaker, and unemployment claims, let's say, might be the first thing to really go up, but 250, 260, 270, jolts is hard because its rate of people participating has been really going down, so it's less reliable than it used to be. And the monthly unemployment data is that payroll data is still there. It's a coincident indicator, not one of the real early indicators, but it will be there. I think if those start moving in negative directions, and as I said, I think some of the government cuts are coming in September, because I think you're on that payroll till, everyone that took that Musk buyout, plus others that worked things out, are getting paid for 9 months. And that goes off, and then they're looking for a job if they haven't already found one, and we're going to have to see how many of that does. So we're going to see. And then there's the normal effect of the increase in the tariffs, which I think are going to begin to bite on certain things in July. So the July CPI announcement, of course, will be for the month of June, of which still a lot has not come through. So you might have to actually wait till August to really see those prices moving up, as they will from some of the tariffs. But a lot of stuff certainly could happen between now and then.
Professor, there's been a few questions coming in, with the Fed policy and overall just the market backdrop. How are you thinking about current valuations, the Mag 7 versus non-Mag 7? How are you thinking about just overall exposure and themes to the market now?
Yeah, I mean, as you know, 4 weeks ago, I turned bullish on for two reasons. First of all, I saw a lot of, technically it looked really strong. there seemed to be a lot of buying. There was also a lot still of skepticism, so it wasn't that everyone was bullish. There's still a lot of caution out there. VIX is 20. Of course, VIX was below, as low as 16 and jumped up 2021 with the Iran situation. So there's a lot of still hedging out there and uncertainty out there. But the major theme, again, is something I mentioned back then and I mention again now, and that is that firms are facing, let's say, just the 10% tariff and some higher on, especially if they're importing the aluminum and steel. They're going to have to move into AI to make those gains. They're going to be the users of AI. And it's going to be, all right, we can, that could offset the margin compression. So earnings might come in better than expected as a result. In other words, there's an opportunity to accelerate AI implementation. Now, does this mean that you should buy AI stocks or buy the stocks that will implement AI? I mean, if you think about it, everyone has been buying the AI stocks, and their PEs, although are certainly quite a bit higher, 50 to 75% higher than that. But the users of AI are the ones that are really going to be the big gainers that have been slow to implement. So on growth versus value, it's hard to call. We've had a really big bounce back on growth, I think, because everyone says, well, that AI story is still going and they're going to have to use AI. But if you think it through, it's the users of AI might benefit more than the competition from the other side. But clearly, I would say that obviously as a group, I think AI has retraced, good 80% of its huge drop. It was down in bear market territory during April and has definitely come back. It's hard to predict, but if interest rates do fall and the economy does slow, again, you have those two factors on the value stocks. The dividend-paying value stocks should do better because the competition is less. The cyclical value stocks are going to feel more from the slowdown in the economic activity, unless they've used AI to offset some of those costs and try to mute that impact.
Kevin, any closing thoughts from you as you think about fixed income portfolios with all this Fed staying higher for longer, maybe for too long? As the professor's saying, any comments on what you would be doing in fixed income land?
Well, I mean, we've been recommending the active passive barbell in this approach, using the passive cornerstone of USFR Treasury floating rate notes, and then on the active side, focusing on our Bianco Total Return Fund. I think it's a nice way of mitigating risks that we see out there, or any tail risks that we've been seeing, whether it's from the Fed or events that are out of our control at this stage of the game. And Professor, I just wanted to ask you one last question is, the money and bond markets seem to be coalescing around the dot plot of about 2 rate cuts for this year. Is the stock market in the same position? Are they, how do you think the stock market would react if it's 2? Is that already factored into the equation and we're going to move on quickly?
The bond market and the Fed funds market, and remember, as we said, Kevin, that Fed funds futures is a biased downward estimate of actually the number of cuts. So even though it might be 2, it's probably between 1 and 1.5 in terms of expected value. That's all factored into the stocks. Now, I think what the market is thinking about is, if we get a slowdown, even though will Powell say that, okay, there's going to be the Trump bump on tariffs, I'm going to ignore that, I'm going to act on that slowdown, and I'm going to lower rates. Or I'm going to be stubborn, that would be the worst scenario for stocks. I'm going to be stubborn because there's going to be a Trump bump on inflation, and I have to look at that as well as the unemployment. I think push comes to shove, the unemployment is going to be, because a number of people are going to say, well, that's a one-time increase, and the unemployment is something you have to look to, and the political pressures will be enormous. And the truth of the matter is, as I say, short rates should be below long rates and not flat like they are now. The truth of the matter is that Europe has, cut many times. The European central banks around the world have cut already. The U.S. has the highest funds rate around of all the major countries in the world by far. And again, I don't think a national sales tax, and that's a tariff is like a sales tax on foreign imported goods, is something that the Fed should raise rates to go against. Fed should raise rates or not delay lowering rates because it sees too much buying and optimism. And I mean, people are buying, but there's not a splurge of consumption. And also, by the way, as we've been pointing out, we're really beginning to see weakness in the housing market, and housing prices and rental prices. And those are, don't forget, rental prices are, implicit owner occupied plus rental plus that whole shelter is 40% of the core of the CPI. And that's a big chunk of that. That's like a whale, and moves slowly. So if that is moving into lower gear, at least for a while, that will offset some of the goods inflation that is caused by the Trump tariffs.
Professor, it's always great getting your comments on these calls. Kevin, always great to be with you. Thanks so much for doing it. Every Fed day, we'll be watching for some of your key insights on how you think the Fed's setting policy wrong. We know you're working hard on some thoughts on that. So everyone stay tuned. The professor's got some views. There was a question that came in, Professor Siegel for Fed chair. We know we all agree on
thank
that.
you.
So we wish that was the case. But Professor, thanks for joining us, and we'll talk to you all again